Hello, everyone, and welcome to a webinar, ESG, Fiduciary Duty and Shareholder Activism from Theory to Action, presented in partnership between the Legal 500 and Galicia Abogados, one of Mexico's most respected law firms. My name is Alan Cohen. I am research editor at the Legal 500. I will be brief in my introduction as we've got a lot to go through today with our impressive panel. Among other things, we will discuss what ESG really means in practice, what it means to GCs and companies, and its growing importance in organizations. But first, let me introduce Rodrigo Rivera, who will moderate a discussion today. Rodrigo, do you want to say a quick hello to the camera so everybody sees you on the screen?
Hello everyone. Thank you.
Hi. So Rodrigo Rivera is partner at Galicia. He's been so since 2018. The general thrust of his career is, let's say, banking and finance. Before he joined Galicia as an associate in 2014, he was in-house counsel at the corporate and investment banking department in one of Mexico's largest banks. Prior to that, he was a foreign associate at Skadden Arps at the New York office for a year. And it was shortly after he conjointly graduated from the Universidad Iberoamericana in Mexico City and the New York University back in 2008. This background allows him to represent both national and international banks, as well as creditors from a range of industries, and to help clients in the structuring and negotiation of all sorts of financial transactions, including corporate and real estate financing, so both on the domestic and international scenes, debt financing and restructuring, as well as state and municipal financing. Rodrigo is a very active member of the Galicia ESG team, and hence why he will be our moderator today. So I will hand over to you in a moment, Rodrigo. But before, I would like to remind our audience that they can ask questions in the Q&A box at the bottom of their screen, and that we will have a dedicated time at the end of the webinar where all our panelists will answer them. So we'll be together for approximately 90 minutes, including the Q&A session. With that, and being conscious of time, I'll hand over to Rodrigo, who will introduce the topic, and the 4 other panelists who are joining the conversation. Rodrigo, over to you, and get us on the way.
Thank you, Alan. Hello to everyone. Thank you for joining. We first of all would like to thank the Legal 500 for organizing this webinar, and thank you to all the panelists here. And obviously thank you to all the participants in what has become a very, very important topic in the whole corporate world, as well as in other issues, but in the corporate world, ESG has become very important. We as lawyers, we have acknowledged this importance, and us at Galicia Abogados, we have an integrated, a multidisciplinary practice group, and with an approach for fulfilling those needs of our clients, and including we make in-house sustainability strategies, as well as issues related to climate change, social impact, diversity, equality, and inclusion. We believe that our ESG practice group will help provide the members of our firm with meaningful work, and help the development and changing the role model with respect to the type of work that private practice lawyers do. We have seen increased interest in ESG issues in general from a whole lot of industries, including financial industries and investment managers and investors in general. So today we will be hearing on a particular topic within the ESG framework, which is the fiduciary duty of board members, of managers, of decision makers of the companies for the inclusion of ESG principles and criteria in the policies and processes of companies. This heightened standard will bring ESG to its utmost importance within the corporate world, and especially taking into account the accountability for the breach of such duty. And with that, I would like to introduce our panelists for today's conversation. They all hold relevant positions in different areas, and we're sure that that we will have a conversation with meaningful content. So firstly, I'd like to introduce Maria Ariza. Maria is an industrial engineer from Universidad Iberoamericana, and she has a master's degree in business management with concentration in finance from Harvard University. She has spent her career in private equity sector, holding positions of like CEO of the Mexican Private Equity and Venture Capital Association, which in Mexico we know as AMEXCAP. She has been a partner of Ictus Capital. Actually, she performs as CEO of Bolsa Institucional de Valores, and as we know it in Mexico, BIVA, which is a global electronic marketplace for buying and selling securities. She also serves as independent member and partner of various board of directors. Maria's career has been recognized with several awards, including an award from the Women Economic Forum and from the International Entrepreneurs Council, and also in publications in several magazines such as Expansión, Forbes, Líderes, and so on. Thank you, Maria, for being here today.
Thank you very much.
Then we have Marius Calvet. Marius Calvet has a law and international relations degree with also a master's degree in human rights in Latin America. She used to work in academia and civil society organizations, but now she has 15 years experience in corporate sustainability. And now she's the Director of Sustainability and Responsible Investment in Grupo Financiero Banorte, which is a major bank in Mexico. She's also the president of the Sustainability Group in the Mexican Stock Exchange. She's the vice president of the Corporate Social Responsibility Committee in the International Chamber of Commerce in the chapter of Mexico. And she's part of the group of founders of the Principles for Responsible Banking, this within the United Nations. She's also a member of the Latin America Committee for the Principles for Responsible Investment. Thank you, Marius, for being here. I'm sure we will enjoy your knowledge.
Thank you, Rodrigo.
We have Álvaro Vértiz. Álvaro Vértiz is the COO and also the Chief Strategy Officer for BlackRock Mexico. He's responsible for leading and overseeing the execution of the business in BlackRock and also its strategy. Prior to these positions, he was the Chief Legal and Compliance Officer also in BlackRock Mexico. Prior to joining BlackRock, he was the Chief Legal Officer for Latin America in Prudential Real Estate Investors. He also has worked as legal manager for various businesses at General Electric Capital. Alvaro has a law degree from Universidad Panamericana and a master's degree in law and business from Northwestern University. Thank you, and hello, Alvaro.
Pleasure to be here, Rodrigo. Thank you.
And finally, we have Larcy Cooper. Larcy is a counsel in the sustainability and ESG advisory practice at Paul Weiss, Rifkin, Wharton, and Garrison, which we all know as Paul Weiss, which is a top-tier international law firm. She's based in the New York office, and she works on a variety of environmental and social governance issues, both for private equity and corporate clients. In September 2020, Larcy was awarded an Aspen Institute First Movers Fellowship. Prior to joining Paul Weiss, Larcy used to work as a securities regulator, securities regulatory attorney, and general counsel for a Silicon Valley-backed green technology startup. Larcy has a JD from Columbia Law School, where she served as well as president of the Columbia Black Law Students Association. Thank you for being here, Larcy.
Thank you for having me.
Now if we should go to our topic, I would like to ask each of the panelists to first give us a brief and general overview on their views on the topic today, which is the fiduciary duty of managers and decision makers for the inclusion of ESG principles in different companies. And after we have this general overview of each of you, then we can move to a more detailed conversation. If that's okay with you, probably, if it's okay, Alvaro, can we start with you?
Absolutely, Rodrigo. And first of all, thank you very much, Galicia Abogados and Legal 500 for inviting me. And secondly, I will say that I'm really honored to share this panel with Marius, with Maria, with Larcy, and with you, Rodrigo. I think we will get a lot of insights and good things about this conversation. So thank you again. So I would like to start saying that ESG has become not just a trend or a fashion, right? I think ESG is here to stay, not because it's a marketing strategy or something that everyone would like to talk about because it's there, right? I think everybody understands, and I think in this room everybody gets the benefit of importing ESG practices in their companies. And I would like to attach this idea to the fact that it's not because it's just a good thing to do, right? I think importing environmental, social, and governance practices not only involves doing good things to your company, the society, the community, the ecosystem, but rather because it actually gives back returns and also allows to mitigate many risks in a really good way. With that being said, I would say that of course it's a fiduciary component to have in our practices, because that brings and gives lives to the best interest of your client or your stakeholders, right, in a broader sense. I think something else I would like to say, and hopefully for the rest of the conversation, is that ESG not only brings value to the shareholders, right? I would like to start talking about the stakeholders as a more kind of holistic way to look into employees, societies, environmental kind of footprint, etc. So I guess part of what I'm saying here is that it absolutely represents what we will have to do, not just in front of everyone related to the company, but beyond that. I don't know, Rodrigo, if I answered the question.
I think you did. Thank you, Alvaro. Probably we should go to this brief introduction with you, Maria, if that's okay.
Thank you, Rodrigo, and thank you, Galicia Abogados, and thank you, Legal 500, for this invitation. And as Alvaro said, it is just such an honor to be here in this panel with panelists like this. And I will talk about the importance of sustainable stock exchanges later on, but just to talk about to go further on what Alvaro said. Driven by many factors, such as investor demand and increasing recognition that ESG factors can be financially beneficial, ESG investing strategies have gone from niche to mainstream, transforming the flow of capital. Just in 2020, ESG investment strategies surpassed 1 trillion for the first time on record after net inflows of 71 billion in the wake of the pandemic. So it is such an important growth we've seen in these ESG branded funds and indexes, and just this will just continue this momentum. So it is just very important to understand that decision takers involving ESG investing impact very much the way the world comes and goes, and they should be sufficiently informed whether companies and institutions are effectively capitalizing these trends to attract long-term investment and secure shareholder support. It is not just now a matter of maximizing financing returns for investors and for taking decision leaders. It is also now a matter of including and assuring to seek a better world for everybody, for all of us. Thank you.
Thank you, Maria. Thank you, Maria. I'm sure we will go deeper into that interesting part you said in a while. Larcy, would you care to give us your overview?
Absolutely. So thank you. I'm really happy to be on this panel and with these panelists. I really appreciate the invitation and the opportunity to speak to this group. I think I completely agree with everything that everyone has said so far. The legal rules around fiduciary duties really haven't changed, but the circumstances in which boards operate has changed significantly. So we've all been personally experiencing and watching corporates grapple with basically these three crises: the COVID crisis, racial justice crisis, climate change crisis. And as a long-term practitioner in the field, what was originally social enterprise and morphed into, to ESG, we've really seen this sort of hockey stick in terms of the interest, both the capital inflows, as Maria mentioned, and then also just, you can't open a newspaper without seeing something about the topic. And so I think the question really is sort of shifting from, is it a fiduciary obligation to how do you sort of deploy that obligation responsibly? And how do you sort of start to consider these things at the board level in a consistent way? That's sort of the reframing that we're even starting to see being, published by, Marty Lipton and Wachtell. And then also even, we recently had in 2020, we had sort of a private conversation with the founder of a top PE fund who described, shareholder capitalism as sort of being the zeitgeist of the 80s and 90s, and that we're now seeing the stakeholder capitalism is really, if you're not considering it at the board level, then you're not doing your job. And so this change that we're seeing is really making stakeholder capitalism considerations financially material. And so you have to sort of engage and be considering them in order to sort of, serve your company and meet the needs of your corporation.
Good. Thank you, Larcy. Finally, Marius.
Thank you, Rodrigo. Thank you, Galicia Abogados and the Legal 500 for organizing this. It is an honor to be here with these co-panelists. Thank you. And as you know, I'm talking from the issuer point of view, and I really enjoyed all these introductions by the panelists here. And there is something when we're talking about fiduciary duty and ESG, I always say, and I love this phrase, that it really means doing good with other people's money. So it is important when we talk about fiduciary duty and ESG to note that fiduciary duty linked to ESG can only be understood and executed when the relevance of the role and the importance of the financial sector in the sustainable development agenda is fully understood. So the role of banks, of investors, here we are sitting down the markets, investors, issuers. So the role of all the financial sector in directing capital towards more sustainable investments and projects is indispensable. So there will be no gram of contribution to the 2030 agenda, to its 17 objectives, to climate change mitigation, if finance is not driven towards these goals, towards a transition to a low carbon economy, towards sustainable development. And not only to be moved towards sustainable projects or companies, but also to be moved away from projects that are not aligned with a sustainable development agenda. So traditionally, the interests of beneficiaries or shareholders have been understood as financial interests. So this creates always an issue. Are ESG considerations in conflict with financial best interests, with profit? Are ESG goals even capable of forming part of the best interests of investors, since they are maybe not obviously capable of reduction to a financial measurement of loss to the investors? And that is what traditionally has been said. But a few years ago, the former US Vice President introduced a program called fiduciary duty in the 21st century that finds that far from being a barrier for profit, there are positive duties to integrate environmental, social, and governance factors in investment processes. So there is also one point to say around ESG and fiduciary duty, and this new concept of fiduciary duty in the 21st century, is that we need to consider, and we, all of us sitting here, we understand how ESG factors, the environmental, the social, governance, how sustainability affects investment decisions. But it is very important to note that it is not necessarily understood how investment decisions towards responsible investments affect sustainability and really create impact. And that is on the side of the issuers. We, us issuers, have, of course, to provide better data, but better programs, better data on real impact, commitment, ambition, goals, and targets. So I think that we should see these two sides. So we have a great pressure as issuers to really provide the real transformation and the real trying to close these gaps on education, poverty, and mitigation to climate change.
Thank you, Marius. We will have your input as issuer very appreciated here. Thank you everyone for these initial remarks. Now we would like to ask some of you some specific questions so we can open up this conversation and we can probably go deeper into the analysis. First, I would like to ask a question to Maria, and starting from the stock exchange point of view. And I'd like to ask if you think that this fiduciary duty for the inclusion of ESG criteria among issuers will be well received by markets and markets and investors in general. That's saying if we have eager investors and to make this kind of investments. And so we can maybe see more and more issuers that they are in compliance with ESG principles, and probably also populate the indexes of ESG companies.
Sure, Rodrigo. Thank you so much for the question. I would like, first of all, maybe to get a little deeper on the importance of the exchange per se. So stock exchanges enable economic growth and development, promoting financial resource flow, acting as a bridge between those who need the capital and to innovate and grow, and those who have the resources to invest. So we do also promote corporate governance among listed issuers, encouraging transparency, accountability, and respect to the rights of shareholders and stakeholders. So in the midst of this development, stock exchanges play a key role in building future. The financial sector, especially from a de-risk perspective, can be a catalyst for unlocking opportunities, supporting clients in reorienting business strategies. So more than 50,000 companies have been listed in the stock exchanges, and they represent more than $86 trillion around. Imagine if we can move these resources, directing them towards ESG priorities, and literally we can really change the world. So this leadership is actually helping to transform the attitude of companies and individuals on environmental issues, reducing, of course, the associated climate change, and encourage long-term view on sustainability. So as a stock exchange in Mexico, we have this opportunity to be one of the pioneering institutions that are driving early track record of financing the sustainability economy. So that we're demonstrating to many the great opportunities that can be seized. We can serve as an inspiration by providing an overview of the possible actions and examples across asset classes, products, service types, and sectors around our real economy. So we believe we're very, very lucky. We're very privileged to be able to construct a sustainable capital market in Mexico. And at this point, we do believe that for the following for foreseeable future, we do see important and new issuances coming following these trends. So just to let you know a little context on what have we done. Only in the past 18 months, we've seen an increase, a very important increase in the issuance of sustainable economy-related debt and equity instruments in our public markets. And of course, we've seen more than 76 billion pesos been issued in thematic bonds since 2018. And of those, just in 2021, 31 billion already have been issued. 40% of those bonds allocated to social and thematic bonds. So we do believe that data is conclusive. Investors are following those opportunities. We've seen a noticeable increase in appetite from the largest managers, such as BlackRock, that is seated right here. Also, governments and multilateral institutions have already been very active, issuing debt and equity instruments. And we do see this data conclusive. If companies do not want to put at risk the connections or the potential financing of the corporations, they must plan their ESG initiatives in a long-term view and address all stakeholders' needs and maximize their value creation. We do foresee for sure more compliant instruments, ESG compliant instruments, more issuers participating, more ESG indices, and of course, more investment vehicles that will be following these opportunities.
I guess that's good news always. and yeah, hopefully we have more. And I'd like to change now to the other side of the coin with Marius from the standpoint of the issuer, and then ask you, how do you see companies adjusting to these increased requirements from investors for them to make responsible investments? And how is this pressure from investors helped the development and the compliance with all of these ESG principles within the issuers, and all of the handling of different frameworks and reporting requirements and so on?
Thank you, Rodrigo. Well, I have to start to say that for all this ESG revolution that we have all been listening to, it poses a great challenge for issuers, but I always would like to start saying how beneficial this is for companies, actually, for small, medium, and large companies in the long term, and actually for the whole economy. For companies, this implies that companies, we need now, us issuers need to have new metrics to measure different topics that maybe we had not measured before. We need to construct structures in corporate governance that maybe did not exist before to actually manage an ESG strategy. Companies need to include different parts of the company in making the decisions. It's not only the topic of financial performance, but of course now ESG brings in many other areas of the company. So it is an opportunity for issuers actually to increase internal dialogue, to have more metrics, to measure different topics. And we always have to understand that for companies, the ESG as a whole implies a topic of tracking and managing risks that are not only financial, that come from very different issues, environmental and social, and of course from not having the right corporate governance and processes of decisions. So it is a topic of tracking and managing risk. It is a topic of maximizing opportunities and taking advantage of new opportunities that the world poses and the challenges pose. But of course, it is the great opportunity to maximize value creation and to have a positive impact on the planet, on people. So I always start saying about the great opportunity that this implies to transform internally the company with dialogue, with including new topics, and with the opportunity to have efficiencies in the topic of environmental operations, to have better performance towards human capital. But also I have to say the other side, which is the great challenges that this is posing to issuers. Us companies, this transformation implies to creating new teams, to developing and doing different processes on how to create the ESG data. We need to actually systematize how we create ESG data, and actually develop these processes as we have it for the financial data. We need to actually standardize how we produce ESG data and actually disclose data in a better way, quality data, to be more transparent, to measure better, to have goals in the long term, to provide forward-looking information. And as you were saying, Rodrigo, this whole universe of frameworks for reporting, of different metrics, rating, scores that we receive weekly as a large issuer, I am talking from my standpoint, this is challenging. This is challenging for companies that have not started yet to do this. This is something that transformed the company as a whole. So I would like to say that we are seeing a transformation of issuers. I am talking from Mexico and Latin America, but it is a huge challenge. Companies really have to invest time and have to really change the whole business strategy to include the ESG topics as material.
Thank you. It seems like a challenge to do that. Now, I'd like to talk to another point of view, which is the investment manager point of view, and with that, I'd like to ask Álvaro, as investment managers, how do you see the importance of the inclusion of this ESG criteria in your investment targets, because you do analyze companies where you are going to invest in, and naturally this should be an issue, and how important is that, and also particularly how important is accountability for compliance with these principles, and not only having them on paper and not doing them.
Super. No, and thank you, Rodrigo. And exactly, I'll talk, on behalf of the asset managers, right? And from the investor standpoint. And I think our business is totally attached again to the fiduciary duty that we were talking recently about, right? If our clients don't trust us in the way we manage their money, basically we will be out of business really quickly, right? So according to how well we do, in terms of how much returns we're giving them, how we are addressing the risks they are facing with their investments, etc. I think it's how we can be qualified as successful or not, right? I'm trying to say this because ESG is totally related to what I'm saying, right? If we are saying, and by the way, there is proof to say that ESG components and ESG investments or sustainability investments performs better results and better risk mitigation options. What we should say is that if we don't import ESG practices within our investment procedures, actually we're missing that point, right? We're not being fiduciary to our clients. I think we have to also look into the two sides of the coins, right? One is the acts of the investors, or that demands asset managers to import ESG as their core value in order to manage their investments. Something that I think Maria and Marius agreed on is that this is not something that we should not be focusing just because we don't want to. I think investors are demanding everyone to focus on that. Our client base, not only for asset managers, but rather for the entire market, are based on how good we contribute to society, how diverse we are on the way we operate, how our direction is going according to a more inclusive environment, etc. Right? So what I'm trying to get in here is that if we don't import all of these practices within our process, investor will not rely on us in order to have their money managed by us. On the other side, as an asset manager, not necessarily attached to this investor kind of front and demand, what we can say is, again, we have seen that the companies or the issuers that have solid ESG practices outperform definitely their peers. I think there's an interesting metric that says that ESG related indexes outperform by 88% their kind of similar indexes without ESG components. So that shows, what I'm talking about. What I also can say is that right now in the mutual fund and ETF industry, there are like $288 billion invested in sustainable assets. This represents like 90% more assets invested through these type of vehicles in ESG components than last year, which is quite outstanding, right? So this shows you that there is a total attachment to the component as how we manage the money. Last but not least, as an investor and as an investment manager, we also focus on the capability of the companies to create value, right? And also in the capability of the company to transcend, to be over the time without facing necessary or unnecessary risks. Something really important is that if we don't take into consideration that environmental risks are part of our financial future and success of these companies, that social risks are not also tied to the way we perform, or that governance structures are not tied to better results, I think we will be out of the game. So long story short, Rodrigo, as an asset manager, we are obliged, not only because it's the right thing to do in order to give better results to our clients and mitigate the risks, because investors demand to incorporate all of these practices in our everyday job.
Thank you, Alberto. Thank you. And now we'd like to change to a more regulatory and more lawyer-like conversation with Larcy, because this is a very legal concept, the fiduciary duty, and it's good, and it's more a U.S. legal law concept, and that's very good. We have Larcy on the panel. Larcy, please tell us from your experience and taking into consideration the inclusion of ESG principles in regulations, in reporting requirements, and which is built in regulation and probably in laws. Is it definite now, or can we consider now that ESG is actually a component of the traditional fiduciary duty concept? And if so, how do you envision the accountability for the breach of this fiduciary duty? Because it's so, as mentioned here, it's important not to have it only on paper, but to have accountability on this duty and to really have measures to see that all of this is being complied with.
Right. Thanks. So I guess I would start by saying that we're really in our practice sort of seeing all of the threads that have been mentioned by the other panelists. So our practice touches funds, our practice touches operating companies. And so we're both seeing the funds efforts to deploy capital that is very committed and interested in seeing ESG integration. We're seeing the efforts then to translate that into the management of the companies if there's a measure of control, or if there isn't, then trying to sort of track its integration and reporting. So, you know, a lot of what's happening is making sure that what's being stated publicly or the policies flow through into implementation and operations. And what funds and companies are in the middle of experiencing also is that as you know, Maria carefully laid out sort of this flow of capital that's coming into the industry. And Alvaro also touched on just the response to that in terms of trying to attract and retain capital and meet the expectations. This has caused companies, even before regulation has started to come into place and to crystallize, to make really committed efforts to sustainability. And so regardless of whether or not it's being pushed forward through regulation, companies have come forward and said, this is what we're doing, this is how we're managing your money, or this is the considerations, and these are the policies that we're going to use to carry forward our operations in the company. And then stakeholders and soon to be regulators are saying, okay, are you really doing what you're saying? And so it's starting to make it much harder to greenwash. I'm increasingly less worried about greenwashing because the conversation is, if you want to get the benefits of being engaged with sustainability, if you want the benefits of being engaged with ESG, then you have to make sure that you're doing what you're saying you're doing. And so you're seeing regulation, you know, is coming out in Europe, it's coming out in the UK. You see the Biden administration is making signals. So we're expecting to see much more action coming up this fall. But in the meantime, you're still seeing companies really trying to prepare, recognizing that, you know, it's early days, so everyone's sort of holding their breath for initial rounds of, you know, investigations as they're coming forward. But in the meantime, you're still seeing sort of that internal compliance and auditing going underway to make sure that, you know, the mechanisms of what you're doing and what you're saying is translating to the operations. And so that naturally, responsibility for that on some level flows up to the board. And so this idea of these KPIs you know, making sure the company's identifying what's material with respect to their operations, making sure that the board understands that and is considering and is educated on ESG, and making sure that oversight is occurring at the board level. That's sort of absolutely essential because it's increasingly an important part of business operations and decision making. So, you know, I think all of us have sort of made the point that ESG really speaks to what the financial markets want to see. And on some level, you know, every corporate is beholden to that in some way. And so the management and engagement with that flows up to the board, and the board needs to be providing oversight to a whole variety of issues. And commitments and have an awareness to the commitments and the goals that are being set with respect to ESG.
Thank you, Larissa. Very, very clear. I'd like to go back probably to Maria and change and go deeper in something you mentioned with respect to debt issuances. We know there are recent listings of debt, especially particularly in the social gender bond recent, which we understand was very successful in its placement, which is very, very important for all of what we have said here. And also it was sponsored by international player, which is also part of all of these global issues. Do you expect to have more of these bonds here in Mexico? I know you mentioned some data of potential investments, but how do you see the Mexican market in receiving all of these new bonds and ESG investment components?
Yeah, in today's environment and context, I think stakeholders, including employees, investors, and regulators, we all care more than ever about the way companies treat their employees and whether the products and services are helping to meet their needs of society. So these social bonds that we've seen are the response in that sense. And basically, just to talk about maybe the one that I like more, it's the gender bond that we issued recently. But the fact of it behind the scenes, no, it is such an important issue in Mexico yet. We've done progress in the achievement of women's rights and gender equality, and we strengthened some of the national laws to ensure men and women equality. But anyway, we do believe gender equality in Mexico still faces a series of structural challenges, and we do have unrelenting gap between formal and substantive equality in all areas of development. And what we need basically it's a public policy that allows women to be with similar and equal rights and opportunities, and accountability for gender equality is still, we believe, deficient, and we do believe politics are necessary and regulation is necessary and urgent. So those ones that we've seen in Viva and other, and we've seen three major events, two of the ones that we saw, FIRA and IDB allocated more than 550 billion pesos in favor of the inclusive of women in the labor opportunities in Mexico. Those bonds were aligned with ESG criteria, just helping to close those gaps in women's access to labor market, position leadership, and of course access to financing, which is a very important issue for women in Mexico. And this was 4 times over the mandate. So this shows an important increase in the appetite of investors in this type of gender bonds as well. And there was another event, a very important event with investors, national and international investors in Mexico, that committed to disclose their commitments in equal gender pay and also to disclose the way their promoted companies include this gender equality within their firms and institutions. So I think with this kind of events, such as the bonds and the firm and the assignment of this commitment, and many other of events that we've seen in later years, we do see we've been moving forward. Investors, not only in the gender part, no, in the social part as well, investors can identify companies that are committed to these topics and are presenting and transparenting their efforts, and I think that's a very important part, a very and historical moment in our country in that sense, no. And so we am convinced that ESG thematic bonds will come and will keep coming, and will create a more equal and society and a more and will strengthen the future of our country and open opportunities for investors and issuers as well. So basically what we see, it's bonds, issuing bonds, new bonds with a specific ESG topics, and a lot of interest from issuers and investors as well.
Good. That's very good news, because in the way that the investors get close and these bonds are so successful, and it means that people are going there. I know, Alvaro, you also mentioned in your intervention, which is also a financial instrument for investors, and you spoke about ETFs with ESG components. We know that you're close to a recent ETF that was created by BlackRock, which is in local currency, which is quite advanced, having an ETF in Mexican pesos, which is related with ESG components. How has been this ETF? Has it been successful, and do you see more of these trackers or probably other indexes with this being successful and investors getting close to them?
Yes, so yeah, to answer the question really fast, it has been quite a really good story to tell. Like this ESG MEX ETF, which is a local currency listed in Mexico, etc., has raised approximately $1.6 billion in AUMs, which says a lot, right? But something that wanted to raise, Rodrigo, is I think it's really important to also to structure firms to give access to the market, to these sustainable products, right? Because the demand is there. The investors would like to put their money in this type of instruments. And I'm not talking about just institutional, sophisticated investors. I'm talking about, the general market, the guy that is starting their investments, kind of journey. They would like to have some sort of, direction to ESG practices. As we like to say, we have to walk the walk and talk the talk. So it's not just talking about how good ESG practices are, how well, we're doing to the world if we start implementing environmental and social and governance best practice, etc. But also is how we can give access to everyone to this type of practices, investors that are demanding that. And this is shown exactly to your question. It's not just the ESG MEX ETF. There are like other mutual funds that are out there that also give access to the general public to this type of investments, right? Something we're seeing is that the creation of sustainable products have enabled a massive acceleration of capital toward companies, which are better prepared to face future changes, including climate risk. In the past 2 years, I think we have seen like a shift of capital that you have never seen, in the past towards this type of investors. I think now, and would like to get back to one point that Larcy mentioned. I think where we have to focus, I think we are creating the products. We have the demand and we have the offer out there. Something we have to be better at is data management. I think right now, particularly in Mexico, Rodrigo, as you know, we don't have a uniform standard to report ESG metrics. So some people follow, or some companies follow SASB, TCFD, GRI, the Agenda 2030 objectives. I think if we can unify that to the fact that we are trying to create this uniform way to see this ESG kind of world, I think we will be way better prepared to give our investors a better chance and a better set of information to allow them to make better investment decisions. But yeah, I think, and long story short, yeah, we are greatly surprised by the interest of the public to get access to this type of investments.
That's very good. And before we go to the Q&A, because we have some questions from the audience, I would like to link this with something that Marius was also saying, and just ask you from your experience, how do you see this in Latin America? In countries different than Mexico, all of this that Alvaro was just mentioning, of all of these framework and forms of measuring the ESG components, and did they reach or did they not, and measured by who, and measured by the principle of who. How do you see this in Latin America and the rest of the countries?
Well, I think that issuers around the globe, actually, but speaking specifically about Mexico and Latin America, are really trying to navigate this whole universe and labyrinth around the ESG frameworks and around shareholders' expectations and what investors are actually pushing companies to do. So I think that issuers, speaking from the region, I think that we are understanding that, and I think that Larcy said it very well. The time for green marketing campaign, for greenwashing is over, and most be over. What actually they are expecting from us issuers is real commitment, is real ambition, is real work behind all the data that they are expecting from us. So we are actually starting to understand what is happening in the region. Can you hear me, Rodrigo?
Yes, we can.
Okay, I'm sorry, I thought you couldn't. So what is happening in the region is that we are understanding that we need to be more transparent. We need to provide better data, quality data for investors to actually make better investing decisions. Quality data means also to provide forward-looking information and scenarios on how our performance is going to look in the long term. In the topic of climate change, this implies to introduce the scenarios around sectors, in different sectors, to introduce the use of science, building scenarios for climate change. It also implies understanding very well the material topics in each company that we are working on. It also implies, of course, and I always go back to, and when I coincide happily always with Maria, we'll always talk about corporate governance. We understand that we need to build the structures in the corporate governance of company, the norms, the policies, and all the culture around the company that includes ESG. So I think we are starting to understand this in Latin America, but I would have to say that in Mexico, at least, I am very well aware that many companies and the vast majority of companies that are reporting ESG are still providing only data that is to the close of last year, from January 1 to December 31st of last year, and that is the data provided. And I still think that we need to push for forward-looking information, targets, goals, commitment, quantitative and qualitative data that provide this long-term performance of the company. There is a very, very short percentage of issuers in Mexico and Latin America that are disclosing on climate risk using the TCFD, the framework that we all know around disclosing climate risk. It is a very small percentage. I would dare to say that it's even 5%. So we really need to push for better disclosure, better data, forward-looking information, systems and corporate governance in the companies. So I think there is still a lot of work to do in the Latin American region.
And I'd like to link and begin with the questions of the audience. We have several, and there's one specific to this topic, so we can probably start with that. And I don't know who will be the better person to answer this question, but I think Larcy, I'd like to, if you have a view on this. The question is, how do investors or regulations manage potential ESG data gaps? Because I mean, as we're saying, as a non-mature data requirement in ESG, we might have gaps in information. How, in your experience, has this been managed?
So I guess a couple of thoughts. One is that I think a lot of my focus on ESG pre-2020 and the formation of our practice group was specifically focused on private equity. And so a lot of engagement in that space had to do with teaching the portfolio companies how to report their ESG data and going through that process of education. And so that was sort of a key element of engagement with the portcos, and was something that you could sort of speak to or also report on that you were engaging with. I think a couple of things. One is to go through the process of understanding what data you should be collecting. And so that's, one of the sort of advisors to our practice group is one of the founders of SASB, Jean Rogers. And she often speaks about how you really just want to go straight to materiality, and that materiality is really what helps you to sort of guide you in your decision making, since ESG is such a broad lens, and it keeps you sort of out of the place of focusing on something that's sort of values-based, but divorced from the underlying goals of the company. And so when you start to engage in that process, especially if you're not, yet a mature company, and so ESG is just like survival. I think when you're sort of an entrepreneur trying to grow an actual business, it's will you be able to make payroll? But then as you start to grow in sophistication and have more of the, bandwidth, resources to be able to start to collect that data and to start to sort of build it into your design, you can start to build it in as you design, but focusing on that materiality component, and then also telling that story. I think that the market does understand that this is a journey that we're all sort of on, and the regulation is still sort of being crystallized. And even when we get to a place where there's sort of regulation, it's hard to imagine that there won't still be some measure of judgment based on how individual companies are positioned and what's most material for them to disclose. And so I think, telling that's part of the narrative and part of the story, and then settling on and driving towards the quantitative components that you think are most material, and explaining how you'll set about getting that information.
Understood. Thank you, Larcy. We have some other questions, and the obligated topic now it's the pandemic. Probably, Maria, you could be more close to this. The question is, what has been the effect of the pandemic on sustainable investing, and do you think this has accelerated the adoption of changing this culture?
Well, it depends on the region, right? Latin America has such important gaps yet to be addressed in terms of financial inclusion or renewable energy, or even industries such as agribusiness, healthcare, education, real estate, etc. So I believe what happened in the pandemic is that despite what we thought was going to be the focus, which was basically the health, caring for the health of people, we accelerated the growth and the interest in investing in those type of ESG ESG components of those industries now. So I think what we are addressing in Latin America specifically is those financial needs and those financial opportunities that incorporate conscious and social responsible investments and are looking to differentiate themselves and attracting new investors. So we saw an increase of investing of 10 times between 2019 to 2020 in terms of capital, but also on the issuances of corporates and governments that were allocated capital to ESG components. So the pandemic basically opened eyes, accelerated the interest of investors and of companies and governments, and just push forward what's going to take potentially 5 years to 1 year. That's what we saw in the markets. A full commitment and full velocity and full strength from investors. Look at the Larry Fink letter and all of the major investors looking at this opportunity. And we saw it in terms of the issuances that we saw in the market in Mexico. Latin America just basically comprised 2% of the total bonds in the globe, and investors in Latin America were the most interested in ESG components. So this trend just came faster than we thought, and great. That was the result of the pandemic for ESG.
Good. At least something good came out of it. That's good.
It did. in many ways.
That's good. We have another question from the audience, and probably this one is better for Marius. The question is, what is the main driver for issuers to consider ESG matters into their decisions? Is it tax? Is it regulatory? Is it better practices? Is it reputation?
Thank you, Rodrigo. That is a great question. And I think that us companies, we have different stakeholders that have different expectations from us. And you really have to take into account and engage in dialogue with your different stakeholders to understand their different expectations. So that is a motivation enough to actually comply with rational expectations from stakeholders. But what I think that really encompasses the big motivation is that a company that does not take into account the whole factors that are out there. For example, for companies that had not constructed or built flexibility or the tools for people to go work at home, were the ones that really had a very hard time and are having a hard time during the pandemic. So there are so many different considerations to take into account that in the language of ESG are spoken about managing risks and taking opportunities. For example, a company that does not develop an ESG strategy is a company that will not have a sustainable growth in the long term, and that will actually become irrelevant in the long term, will not be competitive, will not take advantage of opportunities and efficiencies that managing the environmental and social issues around the company imply. So when we understand that it is a topic of managing risk, and I am talking about risk, of course, around climate change, but of course around, for example, human capital. Who will want to work in a company that has not actually developed a gender equality program, that is a company that does not have a flexibility schedule, or who would want, or which company will be sustainable that is not actually having savings from investing in better technology, cleaner technology, that is not exposed to technology that will actually leave them with stranded assets in the medium or long term. So I think that how I would summarize this is when a company understands that the cost of inaction towards ESG issues is larger than the cost of just doing business as usual. When we understand that the cost of inaction is larger, that is enough motivation to actually develop and take this seriously into the company's strategy.
Thank you, Marius. Very, very, very clear. I'm going for a more technical question to Larcy. I hope it is not too technical, but the question is, what specific matters on ESG can you foresee in future SEC regulations to focus on?
Well, we're seeing a lot of signaling around human capital management and climate change. And so I think that's where we expect to see some more sort of specific guidance. And so I think that's, that's the area to look for. And I think to stay tuned, we're expecting to see movement in the coming months. Frankly, there's been a lot of action. I think also, there's going to continue to be inquiry into funds and asset managers and sort of the end products. So products that have that sustainability lens and like an increased scrutiny there. So I think this was a point that I sort of wanted to mention earlier, but just that idea of thinking about your sort of compliance lines and how those sort of flow through corporate organizations based on the different products and asset classes and levels of control. And so it's going to be sort of, a dynamic compliance structure to some degree that can be responsive to the different characteristics of sort of the projects, the products or the ESG implementation. There has to be a measure of flexibility, which I think, is different than what we've maybe thought of in other, if you're thinking about just like traditional financial accounting or something like that.
Thank you, Larcy. I probably will have one final question before we end up. We still have a few minutes, but there are several questions regarding climate risks and climate change. This one, and probably Alvaro, you might be more familiar with this, but it mentions how the panel assesses climate risks into their investment decisions and portfolio. I know you mentioned something about climate in your investments.
Absolutely. No, and to that point, definitely climate risk is an investment risk, right? Companies that do not see climate risk as a risk owned by them, if they don't manage correctly, are companies that back to, I think it was Marius who said that probably will not have a sustainable kind of company for the coming years. No, and let me ground the point a little bit better. So what's going on with the environment, and we can see the rise of the oceans, as we can see the pollution, the warming, the warming of the planet, etc., is basically challenging a lot of factors within the planet. The agro-industry, the demographics on how the people tend to live, how expensive life is becoming, how harvests are being jeopardized, and that's starting to shift and to change a little bit on how we are used to face our every day, in a personal, professional, etc. Right? If we manage climate risk correctly and import it as an investment risk, companies will be better prepared to face these challenges, the ones that I'm putting certain examples into that, and then they will be able to face them and to address them and to mitigate them in a better way. And that would be also an opportunity that they will have towards or in comparison to their competitors. So something that a lot of asset managers, not a lot of asset managers, that's a lie, it's BlackRock it's doing, is how to factor in climate risk into quantitative data that could allow companies to understand in a really kind of a clear way, not qualitative based, but quantitative based, on how climate risk is impacting their operations and their costs to run a business. And that obviously it's of the importance of investors in order to allocate their money, because investors would like to understand how public companies addresses this type of risk in order to face, the return of the investment that's coming, any moment in time. I don't know, Rodrigo, if that addresses a little bit kind of the question, but definitely climate risk is an investment risk.
Good. Probably we can fit in one more before we make the final remarks. And probably Maria, you can help us out with this one. Do you think, what is your opinion on if the companies should be evaluated more against their peers and not a broader universe, especially in places where regulations or principles are not yet developed or has been are not deep in regulations.
Yeah, right. I mean, there are some investors and asset managers that are more sophisticated and that have internal ways of assigning a qualification or a ESG friendly compliant number to or qualification to a company, and there are some others that do rely on external providers or external index providers or any information provider. So it depends on the sophistication of the investors right now, whether to access information that is provided in an ESG index or from MSCI or from Sustainalytics platform or whatever platform that it's already have done their own qualifications for that company and for that assessment of ESG and for that compliance. And so for an investor point of view, it depends on again on the way they want to focus on or the way they want to internalize their expectations or their priorities to follow up or cross-check their own assessments for companies with other external providers, or choose those providers that develop or that give the information on the specific topics that they believe that they prefer. So the way it really works, or the way that it's now working, it's different providers and different information developers for investors and for the investment community. They get their information out there, and we as investors should do our work and understanding what are they looking at within the companies, and get the information that we need so that we can choose investment opportunities with those companies or those indexes that are being looked at.
Rodrigo, I think you're on mute.
Thank you. Thank you, Mario. It was very clear. I don't know if anyone else in the panel wants to make a final remark or any other intervention. I know Marius was having problems with her connection, but all of this before we thank you all for participating in this.
I had one thought that I wanted to add, is just to maybe consider when thinking also about engagement with shareholders or shareholder activists at the board level, to consider the sort of compounding effect of their different ESG commitments and interests. And so, making sure that you're thinking about sort of the ecosystem, the ESG ecosystem of like commitments in which conversations are being had. Because I think that's another sort of, we've seen that where there's been sort of outsized impacts on boards because, LPs had made other sort of public commitments. And so the ways those sort of started to stack up provided, led to certain outcomes. And so I think that that's just another element of the ecosystem is each player is accountable to what they commit to with respect to ESG.
Good. Thank you, Larissa. Well, with that, and Alan, if you don't have any other issue here, I'd like to thank everyone for your presence here today. I think this was a very good conversation, and we touched very interesting topics and trending topics. And I hope this helped all of the audience as it has helped me in knowing these matters.
Yes, certainly, Rodrigo. Thank you for keeping it within the time that we were given. It was not easy because there was so much to discuss, but it was a great conversation. Really glad to have you all today. And well, I just know that we will upload this video somewhere on our website. Be able to find it typing the title of the webinar on Google. And that's it. Thank you very much. I'm going to end it now and have a good day. Goodbye.